with Coker is a healthcare business podcast from the Coker Group that focuses on solutions to help healthcare organizations effectively navigate the changing healthcare industry landscape.
Welcome to Coffee with Coker, and we want to thank everybody for tuning in to today's episode. My name is Mark Reiboldt, and I'm the host of Coffee with Coker. And joining me once again today is Coker's president and CEO, Max Reiboldt. And Max is back to talk about, this is kind of part two of following up on part one of a series. We're talking once again about private equity transactions with medical groups and medical provider entities. As we've seen a lot more of those transactions going on in the marketplace. This is something we've done a lot of work on and we get a lot of questions about. So we thought we'd cover many of those questions in this two-part series. The first part was on the non-economic considerations in private equity transactions. And I would encourage everyone that is thinking about this topic or this general trend going on to listen to that, because as the title states, we talk a lot about the things that sometimes come secondary to what we're talking about today, but are still extremely valuable and important to look into anytime you're considering a transaction. So those are the non-economic considerations that we talked about there. Today, we're actually talking about the economic considerations. And again, this is one of those things that probably is the majority of the focus and time, energy spent on these transactions when they're trying to get to a deal's conclusion. And it's the thing that typically pops up first in people's mind, particularly if you're on the sell side of a deal like this. If you're a seller, your first thing you're going to wonder is what's the value here? What are we going to get for selling our business? And that's a very relevant question. And as I'm sure people can imagine, there's a lot to unpack with such a question. So that's actually what we're going to talk about today. We have a lot of information that we've published and podcasts that we've covered on various things related to private equity transactions. So I want to encourage everyone, before we dive into the discussion today, to feel free to explore those different publications that we've contributed to and the things that we've put together content-wise, not only on the topic of private equity transactions, but any number of things that we cover across all of our services and areas of expertise. You can find that information via the website, cokergroup.com. You can also find not only this episode of the podcast, but all episodes of the Coffee with Coker podcast at coffeewithcoker.com. And then, of course, you can sign up for email updates where you will get regular information, blogs, articles, white papers, podcasts, et cetera, in your inbox each week. So we thank everybody for subscribing there, as well as you can find us on social media, which is another great source for staying up to speed on Coker's publications. So with that, we want to move on into the discussion. Well, maybe first I should give a little bit of disclaimer here. When we're talking about economic considerations in any transaction, but in this case, we're talking a little bit more specifically private equity and provider entities, we could literally do hours and hours getting into the technical nuances of everything that's involved and unpacking these types of things. Obviously, there's a lot there. So we are going to cover this topic in a fairly high level today. So we acknowledge the fact that anything we cover here, there's going to be a lot more to it. We, again, cover a lot of that stuff in some of the white papers we've done on this topic and other podcasts, articles, et cetera. So there's a lot more there. But to the extent that maybe we raise the surface on a couple of things that require more detail, we would really encourage you all, just reach out to us. We're happy to answer any questions, go into more detail, talk more specifics, whatever it may be. If this is something, a topic that's of interest or relevancy to our audience out there. So, but with that, I thought we'd start off. When we talked about the non-economic consideration, we talked about deal structures and some of the things some of the common trends and things to kind of be aware of and to look out for and just to be cognizant of, I guess. And I thought we could kind of do the same thing here when we're talking about the economic consideration in a deal, or basically we're talking about financial terms and valuation. So why don't you, if you don't mind, maybe run us through just some of the things that pop up when we start talking with, whether we're working with a buyer or a seller, and we start the conversation of value. What are some of the things that we think about in terms of a deal structure?
Yeah, thanks, Mark. Glad to be here again on this part two of our discussion. So, to get right to your question regarding economic considerations, there are, not surprisingly, quite a few, I guess you'd say, areas of review and consideration, not the least of which that seems to always come up pretty early in the discussion would be the upfront value. Most private equity firms and most physician groups that are looking to affiliate and become a part of some form or fashion of a private equity deal are looking for some upfront dollars. And this is a fairly significant variation from other transactions, particularly those with hospitals and health systems, where very little upfront money is usually exchanged, maybe only enough to pay for and value the hard assets, as it were. The compelling thing with a private equity deal, though, is in many instances, earnings are quote unquote created, which I'll get to in just a second. And as a result, because they are there in a normalized or restated financial statement and are projected going forward, there is call it what you like, depending on the methodology, excess earnings, free cash flow, et cetera, that are used then to quantify uh, value, which is then paid to the physicians, the partners up front. This works very well for older physicians, particularly those that are, let's just say, in general, are 3 years or less before their retirement, because they're really not looking at a long period. And so it's very compelling and obviously very enticing, because a lot of practices don't have near the succession planning economic terms that would be comparable to what a transaction like this would offer. The second major thing that is in play here, though, is somewhat of an offset to the first, meaning the upfront money. And that is what we call the post-transaction compensation to the physicians. And again, more specifically focused on the partners, but really and truly every physician, if they're not a partner. And so you really can't have it both ways. Uh, it's kind of a teeter-totter effect. If you create more upfront value, whether it's a discounted cash flow methodology or even an in-market approach, multiple of EBITDA, you're inevitably cutting into what the new employer, in this case, the private equity firm et al., would be able to pay. And so it's kind of one of those choices. You want it up front? Do you want it on an ongoing basis, or do you want some hybrid? Generally, it is some hybrid that's resulted in order to get a deal done. So those are the two major areas. The other thing I would say that is somewhat compelling, actually, I'll say it is compelling to do a PE deal, and that is what we call fondly the second bite of the apple. Generally speaking, most groups and most private equity firms are not interested in selling and buying, respectively, the full equity percentage value of the practice, the MSO, or whatever it is they're buying. So let's just say hypothetically, the practice uh, retains 25% of its equity. Well, the good news is it can continue to get some distributions off the earnings of that 25%, if in fact any result post-transaction. And the further good news is that almost all private equity relationships are looking for some out down the road, meaning, and it's a good thing, meaning some second and more full or complete divestiture. And presumably they've grown the value to a higher amount. So even though the practice is second time around only selling 25% because that's all they own, it could be worth incrementally a great deal more than what that 25% would have been when they retained it vis-a-vis the sell-off of the 75. So that second bite of the apple can be extremely lucrative and very enticing because, again, it goes to the physicians. So I'll stop there, but I'd say those are the three major components economically that we're considering. There are others, and we can get into them, or more of the mechanics of how they're derived. I will say quickly, there's nothing magic about how earnings or EBITDA is derived in a PE deal. They just simply lower the compensation to the physicians on a pro forma basis. And then in reality, that's exactly what happens. We call it a haircut, where the doctors take less earnings, and that creates more bottom line from a historical standpoint, and even certainly going forward. And that amount is capitalized, discounted back to present value, et cetera. And, lo and behold, you've got some upfront dollars.
Yeah, that's a good actual segue into what I wanted to talk about next. But just to break it down for folks that may not be as familiar with this, to clarify for myself and to recap a little bit what Max said, normally medical practices aren't retaining a lot of earnings, meaning their profit is being distributed to the partners, the owners. Therefore, from an accounting perspective, looking at a financial statement, you're not going to see a significant degree of net income, or what we call EBITDA, earnings before interest, tax, depreciation, and amortization. EBITDA is kind of a common, globally referred to term for profit, for earnings, for the goodwill value of that enterprise. And we'll talk about the different approaches of actually valuing EBITDA, but the point of creating the EBITDA, as Max went through, is to do exactly what he said. You can get a multiple of that created EBITDA up front instead of continuing to take it as compensation going forward. And that's how that upfront value, or those upfront dollars, are created. But that does require a reduction in compensation to some degree. And now how you get into calculating what the compensation is, and is it globally applied across all partners, everybody in the group, whatever, that's an example of that nuance and that real nitty gritty detail that we honestly don't have time to get into today, because it could go so many different directions. The answer to that general question is yes, you can skin that cat any number of ways, but it's not going to be, here's the single way it's done, and this is the way we're going to apply it in all situations. It can definitely vary. Sometimes it's pretty simple. Other times it can be a little more complex, but that compensation haircut is obviously essential to creating that upfront value. Now, what I think this takes us into is the approaches for calculating the value. So now let's say we have calculated our normalized EBITDA, and we have some number there. There are, generally speaking, and there are a number of different, technically speaking, a number of different valuation methodologies and approaches, and even nuances within those. We're going to briefly talk about two of the, generally speaking, more common ones that are applied. And in many cases, both of these methodologies are applied in any given transaction, and to kind of, check off each other, and a little bit of check and balance effect there. But one that Max alluded to is the discounted cash flow. And it's one of the methodologies under the income approach. Again, a lot of technical nuance here. But in this case, maybe describe, generally speaking, you kind of just did there at the end of your comment, as far as discounting back to present value. But if you don't mind, just broadly cover DCF in like a PE transaction scenario.
Yeah. So discounted cash flow, or more specifically, the income approach, is one of the three major approaches to valuing healthcare entities. And we subscribe with our certified appraisers to the American Society of Appraisers and their standards and their protocols, which is really kind of the foundation for properly assigning value and doing valuations or appraisals of healthcare entities. So the discounted cash flow is really the methodology under the income approach. And the income approach essentially applies very logically a historical income statement. It mirrors or replicates that with, as you pointed out, Mark, some normalization, meaning that there are some legitimate one-time only revenue or expense items that wouldn't be recurring. Let's say you sold a bunch of furniture or something and realized $50,000. Well, that's not normal income, so you'd take it out. It's not something that you would do every year. And by the same token, there could be some expenses. Let's say maybe you had a year where you inordinately had to spend a lot on legal fees. You would take those out. So the DCF is really a mirror image of an income statement that's converted more so to a cash flow summary, because you do consider the cash in and cash out of those. And so, for example, even capital expenditures are essentially the cash is considered, not the depreciation. And so what you end up with is a modified income statement. And then in theory, what the DCF says is, well, if you build a model based on an accurate baseline year, which is fundamental, and then you extrapolate over typically a 5-year projection period, you're going to have various assumptions of growth. If, for example, the real estate leases go up in 3 years, you would recognize that increase in your modeling of your expenses, specifically lease cost, et cetera. And so you end up with, hopefully, some excess earnings. Well, where the real issue, I don't know if it's an issue, but nonetheless, where the kind of the parting of the ways takes place is under a private equity transaction using this DCF. You would, the line that is typically applied to physician compensation when hospitals have that done, typically it's whatever the comp has been, and often it's everything that's left over. So there is no real excess earnings, and therefore there's no value other than the hard assets by definition. Well, private equity approaches it a little different, a lot different, actually. They will invoke this physician compensation haircut. So let's say, hypothetically, you had $1 million of physician comp, and that resulted in a net, basically break even point on your modeling. Then you really wouldn't have any value. You resort to the tangible asset value. On the other hand, let's just say we took a 20% reduction in pay. Well, that $1 million becomes 800,000, and obviously and quickly, you almost like abracadabra, you've created $200,000 of earnings. And then you apply those earnings based upon a year upon year in your model, and then discount that excess that results back to present value. So you've actually, under a DCF methodology, you've created upfront value, not unlike what the private equity folks do every day. And so that's really the DCF in a nutshell.
Yeah.
It is a highly recommended model because it's based on pretty sound principles and assumptions and all those things. So it's very often applied.
With that explanation, literally that's the 30,000 foot view. So again, just for folks out there listening that may not be as familiar with these types of things, there's an incredible amount of nuance that goes behind that, everything you just said. And in addition to that, I'll say two things. One is what happens after you arrive at some sort of 5-year, let's say, pro forma, forward-looking projected statement and the value that happens there. It's ran through a number of, I'll just call it a number of steps and adjustments that account for things like taxes and depreciation, amortization, capex, et cetera. And then there is what's called the discount rate, and that's something that oftentimes you'll actually see is a very pivotal thing in negotiating valuations is what discount rate was applied. Well, we used 12 to 14%, or we used 7 to 9%, or we pinpointed at 8.5%, whatever it may be. But anyway, that discount rate is the key thing that brings it back to net present value. And so, and again, oversimplifying here, you ultimately kind of go follow the progression of the modeling and arrive at enterprise value. And again, there is a lot there. It gets very technical. The second thing I was going to say about the DCF is that it is a very helpful gut check in many cases, but there has to be an understanding that there is subjectivity applied in the DCF, precisely in that we can try to get as granular in the analytical processes as we can, but at the end of the day, there have to be assumptions being made for those projections, and they have to be. All those assumptions are going to be based on something, some form of rationalization and an understanding of why they're being applied. But again, we could say this year we're projecting 5.5% revenue growth, and it's going to trickle down from there. But at the end of the day, we don't know that it's going to hit 5.5%. And so there's a little bit of subjectivity there. Mm-hmm. The other one that I want to just cover from a high level standpoint, again, it's used very much in partnership with DCF. And that's what we call the market approach. And again, I'm oversimplifying here. There's a lot of nuance. This is one where you're going to hear a lot of the discussion around, and a lot of times the negotiations in these transactions, in my experience, and correct me if you've seen something different, but this is where a lot of the discussion ultimately comes to, because you'll often be in a case where heard, hey, 7.5 times EBITDA is the right value. And it's a pretty simple calculation. It's literally a multiplication, but the devil's in the details as always. So talk about kind of the nuances of the market approach, and then, the importance of understanding market multiples and comparables and those types of things.
Yeah. And that's really where subjectivity, even in my view, even more so sets in private equity deals.
Yes.
One thing that we should also note that compliance is alive and well, even in private equity deals, but they're probably not as highly scrutinized from a fair market value standpoint as certainly health system and group deals are, for obvious reasons. There certainly are some compliance barriers and or guardrails that have to be set up even in private equity deals. So with that said, the market approach does just that. It really looks at a historical earnings. And again, we're usually talking about EBITDA. And that could be a restated earnings or normalized, again, to adjust for non-typical expenses or revenue, as it were. And then, as you note, it's pretty simple in that we assign a multiple. And from a buyer standpoint, the multiple is such where they hopefully can see a return on their investment over a period of time through the earnings that would result. And so they're willing to essentially give part of the future earnings of the business to the physician owners up front. And then in turn, they bought that earnings stream, let's say it's 75%, and that's how they're going to get their payback and hopefully a profit. So the multiple is a key factor in the sense that it is subjective to a point. It's often based on what have you done for me lately in terms of the assignment of a multiple. It's very volatile in the sense that it can go up and down fairly significantly in a relatively short period of time. And so it's supposed to be very much a reflection of the market and even the local or regional market that we're dealing with, not just national. And so multiples are always a subject of negotiation and often disagreement. I hesitate throwing any out for specific entities because depending on where our listeners are, that they could be right or wrong or somewhere in between. It is very localized. I will say this, that the practices that are looking to do PE deals, the multiples are going to probably be on the really, really low side, maybe 3 or 4 times EBITDA, and on the high side, 6 or 7. Surgery centers, endoscopy centers, et cetera, generally have a little higher multiple, assuming they're stable and historically profitable and how much. They could go, we see those even today as high as 8, 9. Occasionally you might see a 10, but most of the time they're in the 8 to 10 range of multiples of EBITDA. And so it's a very, very important consideration. And the market approach is often applied first and foremost by PE firms. They'll do the DCF or allow it to be done. But my experience, and just speaking for myself, and I think our whole firm's pretty much this way, is that it's usually a market approach and that they prefer, not a DCF.
Yeah. Yeah. I think I would agree. I think the market approach, at least on the surface, can seem much simpler.
Mm-hmm.
And because again, you say, yeah, it's 7.5 times, and you kind of do the calculation. But what goes into that, again, there's a lot. First of all, it's very much akin to what you go through the first stage of the discounted cash flow analysis is you come to some sort of normalized earnings. You have to figure out what that true normalized EBITDA figure is for a base year.
Right.
And you don't necessarily have to do projections for this because you're taking that base year and then you're putting a multiple on that. So you're actually trying to arrive at a similar number using both methodologies. One, you're arriving at it from the base year going forward with a multiple, and the other, you're going out 5 or so years and going backwards through the discounting process. But with market approach, to your point about kind of some of the general ranges that we see, I think we have to definitely put a major caveat there that it is a continuously evolving, changing, almost a fluid process to where multiples are. And the real crux of understanding or getting to a valid market approach valuation lies within the comps that you use, the comparable transactions.
Mm-hmm.
So when we go in and do this, we will absolutely look at a wide range of transactions going back, some reasonable period of time. And we will first try to figure out what were the valuations in those deals so that we can actually figure out what the multiples were applied in those transactions, which is oftentimes is not necessarily easy or on the surface to find even that. But then we actually have to go into each individual transaction and evaluate the characteristics. Was the entity the same or of a comparable size? Is it in a similar region, or is it in a region where there's some sort of nuanced market dynamic going on that would affect values? And really look at the characteristics of each transaction, because comparing a 50 physician GI group to a 8 physician ENT group, those are apples and oranges, literally. And so we can't just take that on the surface and apply similarities. And I don't know, and I'm sure you've encountered this, but I don't know how many times I've had people reach out and say, well, I know one of my colleagues in the next county over, they got like 8, 9 times earnings for their deal that they did. And it's like, well, I mean, we're talking night and day potentially. I don't know the nuances of that, and I don't know the characteristics of that came along with that transaction. But there's a lot to consider there. So we can't always take it on the surface, and we do need to take everything with a grain of salt when we hear these types of things being thrown out there. Would you agree?
Yeah, there's no question. There's all kinds of nuances, and don't forget that even after you get an offer, there's always this period of due diligence and really drilling down, which inevitably could change both the EBITDA assumption that you're working off of in a market approach and the multiple, and again, both. I saw an offer from a client of ours, to a client of ours, actually a dermatology practice in the last week from a private equity management company in that space. And on the surface, and I'm not saying it isn't, it looked pretty good. In terms of a multiple, it was about a 10 multiple. Obviously, the dollars are huge, but when you drill down and kind of dissect it a little bit more, you can see that uh, it could all still come about. Hopefully, it will. But there's all kinds of due diligence that has to be done that can potentially make the deal or the amount, let's just say, adjusted before the actual deal gets finalized. And then, of course, if you get down to the second bite of the apple, you're going to go through the process somewhat again, of valuation and all that. And but it's I guess it's I don't know if it's which it is. At times it's an art, and sometimes it's a science, and sometimes it's both. But clearly, there's a lot of moving parts that any practice in particular has to really keep in mind and make sure of when they're contemplating a private equity transaction.
Yeah. Again, it's happened many times where the question comes up, hey, I'm a XYZ specialty. What are some range of multiples that you're seeing go on in this space? And, honestly, I wish, and I always kind of hate to have to respond this way, and I wish I could respond better, but it's like, obviously we need a lot more information. And so, sometimes we get those cases where it's like, hey, those Coker guys says, derm deals should go for 10 times EBITDA. Well, no, that's not necessarily the case. It could be a very different scenario for any other group out there. And there's a lot that goes into that, and it may not end up being that way at the end of the day. There may be some adjustments and changes. The other thing I was going to mention is that the differences between, and this is something we won't get into the nuance of this here, but we covered it in the part one of the series where there's typically going to be a different, not approach, it's the same approach, but a different mentality around valuation. If you're talking about a PE sponsor doing what we call a platform deal, meaning their first entree into a particular market,
right?
That's kind of their platform to do additional acquisitions and then ultimately grow the entity and sell it. But the differences of a platform deal versus an add-on deal is just going to be different. And again, how those differences can kind of flow, what those differences are, that's again, an entire discussion in and of itself. But again, they're going to apply the same technical methodology, but some of the assumptions that go into that may vary a little bit.
Yeah, and just a couple of points to illustrate that, which is a very valid point you're making, Mark, is first, it is a fact that if you're the platform practice, the old classic planting of the flag in a particular region, there's a high likelihood to allow the PE firm / investor, even a VC firm, to invest. They're going to give you a better deal to get their foothold into the market or the region. So now, how much better, it's debatable. I've seen, some that are, I'm not sure they would have ever got anywhere close to that number had they not been the platform or kind of the guinea pig, if you will, in a region. The other thing I think that's interesting, and again, this illustrates why private equity firms have more flexibility, vis-a-vis compliance in some of those areas than hospitals or health systems do. I saw an offer to an orthopedic group that had in their physicians as investors in a surgery center. They weren't the only owners, but the offer was for one additional times multiple of EBITDA if the orthopedic surgeons, who were significant owners in the ASC, but not the only ones, could deliver the ASC in the package. So I forget, and it doesn't matter, but the multiple was without the surgery center was, let's say it was 9, and the multiple with the surgery center, if you could bring it with you, so to speak, it was 10. And so that's obviously an enticement, and good that it is. Uh, they're within legal boundaries, so it's not I don't think it was an anti-kickback issue or anything like that. But it's interesting because you typically won't see that with hospitals. If they're going to offer, they're going to pretty much be regulated to toe the line and not give that level of flexibility. At least that's our experience in working with hospitals along those lines. So you definitely will see a lot more innovation, if you want to call it that, in private equity deals.
Yeah, that's a good example of you could say again why you could ask why are we so particular about understanding the nitty gritty details of our comparable transactions is because of things like that. Obviously, we would want to know that and understand that if we we're going to use that as a comp going forward to apply to another deal. Also, it's something good to know that, hey, if there's additional value that you could bring to this buyer, maybe you have an MSO, maybe you have a particular piece of technology that you've developed or something, a surgery center or an ancillary service, anything like that, that could be additional opportunity to enhance the value of those upfront dollars.
Mm-hmm.
And, you're typically not going to see such a drastic range of value in negotiating that you're going to be going multiple points, meaning you're probably not going to have, I wouldn't think in most cases you're going to have, a seller thinking they should be getting 9.5 times EBITDA on the buyer trying to get them for 4. Mm-hmm. If that's the case, then there's been some sort of kind of misalignment or miscommunication and misunderstanding as far as what's really at stake and what we're trying to do. But if you're kind of going back between a few points, a couple points here and there, and you can kind of justify that variation in those figures with some sort of evidence or compelling argument, then we've seen those kind of things sway that way. Mm-hmm. Which brings me to we can kind of come full circle here and wrap this up. And this is going to sound a little bit like self-serving for Coker, but in general, I think it's very much a relevant thing to point out the value of having, even if it's just from a valuation standpoint. I think there could be a compelling, I know there's a compelling argument to have an advisor familiar with these types of transactions, involved in all aspects of a deal. And that's one of the things that Coker has done for many years. But a part of that is the valuation analysis, the appraisal process, really getting into the nuances of that analytical exercise, and then applying that to deal structure and different financial and economic terms. Mm-hmm. So maybe just talk about that and any anecdotes you've seen over the years as far as creating value for clients through this valuation process.
I think the first thing that, and we work with practices, both, I guess you would say, fairly early in their evaluation and assessment process as to which way they want to go with private equity or health system or something else, or just staying totally private. And so I'd say if that's where a practice is, they don't need to rush in and try to get a deal done. Hopefully they've spend time, do their homework. And then the whole issue of value proposition, I don't want to infer, let's say that it's some sort of manipulation of earnings, because you wouldn't do that. That's not appropriate. But if you have enough time and management wherewithal, capital, whatever it takes, you could grow and realize a greater multiple. So let me give you an example. The easiest one to illustrate would be, and pick a specialty, would be as if you're not doing an ancillary service that generates earnings, additional earnings. Well, with or without an affiliation transaction in mind, private equity or hospital or anything, it seems like it would be a pretty good idea to me to develop that and enhance your total income and earnings. Well, if you do that, obviously there's some startup costs to that, maybe an investment in a MRI or some other imaging piece of equipment, but you can spread that out. And often, if you have enough a good reputation, referral base, et cetera, where you're busy, your patients will readily accept utilization of those ancillary services. Again, let's just continue with imaging as an example. And that creates more profitability with or without a deal. But with one, we can use it as a valuation assumption. The one that is kind of out there, well, it is out there, but can be a little bit treacherous to navigate, would be reimbursement changes post-transaction. And so most private equity firms, unless they've planted the flag and they really have the wherewithal to do so, my personal feeling is they don't bring increased reimbursement with the commercial payers to the table. Now, again, there could be exceptions to that. Health systems almost always do. So let's just say we've got a major health system that's looking to align in a community with orthopedic group. And the orthopedic group may have decent rates, but because they're let's just say in my example, a relatively small group, they're not going to have the reimbursement rates. Let's just say, again, very hypothetically, upon a black box review, we determined that the hospital's is getting 150% of Medicare rates for their commercial carriers, whereas the group is getting 130%. Well, 130 is not bad. 150 is a lot better. And so whatever that is, 20 percentage points greater, and whatever percent that is, the question would be, can we tie the value of the practice to the deal? Well, I can tell you pretty much unequivocally, you can't do that in a hospital deal. You can't assume those future rates. On the other hand, if the private equity firm and has already aggregated several practices within a region, you're not the flag planted one, so to speak, and they've already garnered, because of their strength in numbers, a 150% of Medicare rate, then I would say there's a potential where there's a little more flexibility on their part to share part of that increase, that lift in reimbursement in the upfront value. Now, again, want to be careful there and not overdo it or not go outside those white lines of compliance legality, but there's just more flexibility for groups, private equity, to do that. And health systems would just not, you can't do it. It's too closely tied to referrals and obviously the ramifications and stark violations there, and possibly even the anti-kickback statutes too. So those are just a couple examples where we can see opportunities in private equity deals, and let's just say kind of anticipating how you could increase your value before you actually complete the deal.
Yeah, and I think those are great examples, and that's just one scenario. I mean, it may be on the reimbursement side, it may be on working with group purchasing, or something from a revenue cycle management perspective, billing and collections. There's oftentimes value and scale. Obviously, if you do it right, and again, within those boundaries of compliance. But I think those are a lot examples of the many different things we're looking out for when we're going through this valuation process. And it's not just an analytical exercise; it is very much a strategic exercise, a tactical exercise, and frankly, just important as looking at financials and volume and CPT utilization. All those quantitative things we look at are just as important as those. We have the non-economic things that we talked about previously. So I think that's a good way to kind of bring it full circle. Again, I want to be very clear that we acknowledge that we've covered this in pretty high level detail. There's a lot of stuff here that we could unpack in much greater detail and spend more time on, but we thought this would be a good way to at least tee up some of these things and maybe give our listeners some general things to look out for, some things they can jot down to get more information on, whether it's from us or from other resources out there. Obviously, we would encourage anybody that has questions on this or anything like it, again, any part of a PE transaction or a hospital affiliation, reach out to us and we'd love to answer those questions for you. But with that, thank you once again. And this is something that, again, please stay tuned because we'll continue to cover this topic and the progression of it in the future. Thanks for listening.
We hope you enjoyed that episode of Coffee with Coker, and we thank you for listening. We want to encourage all of our listeners to participate and contribute in the podcast. So if you have any questions on any of the things we discussed in this episode, any of the topics that were presented, please feel free to ask us. Also, we welcome your feedback and suggestions. If you have any ideas related to the material we discussed in this episode, or in any episode, please let us know and we'll make sure to incorporate it. And if you have ideas for topics you'd like to hear more information about in future episodes, please send those suggestions to us. We would love to hear them and we'd love to incorporate them into our future episodes. You can find us online and on social media. Start with our website, and specifically the podcast is coffeewithcoker.com. You can also find that through the main Coker website at cokergroup.com. You can also find us on social media, Twitter at Coker Group, and then on LinkedIn, you can search for Coker Group and find our page and the page for some of our team members as well there. So you can find us and reach out to us a number of places. And then if you want to contact us directly, one of the best ways to do that, email feedback@cokergroup.com. That's feedback@cokergroup.com. And again, we'd love to get your feedback. And we'd love to encourage everyone to subscribe to the podcast so that you can be notified when future episodes are released. We look forward to the next episode, and we look forward to getting your suggestions and feedback on this episode. Thanks for listening, and we look forward to speaking with you again on future episodes.